With 4.6 out of 5 stars on Amazon, being ranked number 2 in finance and number 156 in bestsellers, I offer you 3 essential lessons from the book The Intelligent Investor. The definitive book on value investing by Benjamin Graham. Cheerfully recorded by Cool Cat Investing. Lesson 1. Consider defensive investing style for your foundation. Defensive investing style allows you to achieve sustainable market average returns with minimal risks and time commitment. How? Very easy. All you have to do is to invest in low-cost index funds consisting of all companies in the market, such as S&P 500 for the US and S&P International 700 for the rest of the world. Why invest internationally? Imagine you are a Japanese investor in 1989. In the past 10 years, your domestic stock market dramatically outperformed the American one, the Japanese tech industry is booming, and your companies are buying US assets. Do you remember what happened next? After reaching a maximum value of almost 39,000 in 1989, the Japanese stock market index Nikkei 225 dropped 80% to about 8,000 in 2003 and never recovered to all-time highs since. Currently, it stands at about 26,000. Besides, if you live, work, and have real estate in one country, you are already betting big on it. Diversification might be a wise decision. But do you sacrifice higher returns by abandoning actively managed funds and investing in index tracking ETFs? Not quite. Research done by S&P Global shows that passively investing in an index of all stocks outperforms about 90% of funds managed by professional investors over 20-year periods. Investing in index funds also provides you with an enormous advantage of diversification. Data shows that very few stocks provide most of the gains of the stock market, so instead of trying to find a needle in the haystack, isn't it easier to buy an entire haystack? Additionally, this ultimate diversification allows you to minimize the risks of permanent loss of capital for as long as the economy of the world continues to grow. You also may consider the dollar-cost averaging approach. Investing a fixed amount of money every paycheck or every month. This practice removes the need to guess the best time to invest, as it is close to impossible to time the market and buy at the bottom. A study done by 2 finance professors at Duke University discovered that if you invest based on the recommendations of the best 10% of market timing newsletters, you would have achieved a 12.6% annual return between 1991 and 1995. Ignoring them and investing in an index have achieved 16.4% per year. But perhaps the biggest advantage of this style of investing is the minimal requirements of time, as purchasing index tracking ETFs can be automated. Now you can boldly pursue your career, social life, or hobbies, knowing that by spending no more than 1 or 2 hours a month, you are expected to have sustainable returns higher than 90% of professional money managers. Remember, if you spend more than 1 to 2 hours per month on this investment style, you probably do it wrong. Should you have 100% allocation in stocks? Historically, stocks did outperform all other investment vehicles, such as bonds or commodities, and kept up well with inflation. However, the book claims that a lot of investors who purchase shares often achieve lower returns than the stocks they own by an eye-watering 4.7% annually. Why? Because investors often panic and sell at the bottom during market downturns and re-enter later at the top of the market. For these reasons, the authors advise considering 100% stock allocation only if you have enough cash outside of the stock market to support your family for at least 1 year, are willing to hold money in the stock market for at least next 20 years, have experience going through severe bear markets such as 2000 or 2008 and not selling any stocks. Chose index funds with extremely low cost of ownership, the so-called management expense ratio. Have reasonable expectations about the future stock market returns. Unfortunately, investors' expectations of future stock market returns often depend on past performance. In the middle of the tech bubble in 1998, U.S. investors surveyed by Gallup organization expected their portfolios to earn 13% next year. And by early 2000, at the peak of the tech bubble, the same investors' expectations for the next year jumped to 18%. After the stock bubble popped and stocks dropped 50%, the expectations slumped to only 7%. What are the reasonable expectations for the U.S. stock market returns? Let's find out. There are at least 5 ways to harvest stock returns. The real growth of business earnings per share happens mostly due to technological progress. In the past, this growth averaged 1.5 to 2% per year. Dividend returns. Recently S&P 500 yielded between 1.5 to 2% per year. Earnings growth due to share buybacks. Increasingly popular since the early 2000s, these days company stock repurchases account for between 2 and 3% of earnings per share growth. Prior to 2000, the companies mostly returned capital to shareholders via dividends, with yields averaging between 3 and 6.5%. Speculative change, measured by expansion and contraction of P/E ratio, should not contribute to growth over a sufficiently long period of time. The observed long-term average P/E ratio for the U.S. stocks is around 15, with expected fluctuations between 5 and 35 plus. Inflationary expansion, which is excluded from real growth. Therefore, in these conditions we can expect between 5 and 7% real return on stock investments. Not surprisingly, the observed long-term average P/E ratio of 15 implies this return, as 1 divided by 15 is 6.7%. Also, historical U.S. stock market returns since 1870 is about 6.7%. However, it is important to note that past performance does not guarantee future success. Also, please be mindful that a 6.7% expected market return implies no change in P/E ratio. If you invest when this ratio is at 25, as it was in 2018, and it eventually returns to the observed long-term average of 15, your expected stock market returns might be dramatically lower. 100% stock allocation is not a one-size-fits-all approach. Based on your interest in withdrawal rates, investment horizon, and fortitude of your digestive system or risk tolerance, you can incorporate other investment vehicles such as bonds, REITs, etc. In this case, decide on fixed portfolio weights for each of the investments and rebalance yearly. The act of rebalancing your portfolio might also help to alleviate the urge to do anything disruptive during the sharp fluctuations of the stock market and stick to the chosen weights. The book gives special consideration to gold bugs. Gold doesn't actively generate interest and is based on the will of somebody to buy it at a greater price. An intelligent investor with the desire to have some exposure to gold might consider a gold miners ETF with a low management expense ratio for their portfolio. What is historically proven to show below average performance over a long period of time are the mechanical formulas, such as, for example, buy top 10 stocks with the highest dividend yields at the beginning of each year, or sell in May and buy in November, etc. Even if there is evidence that any of them temporarily generate additional returns, once the mechanical formula becomes known by many, it starts to underperform. Ergo Lesson 1. Consider defensive investing style for your foundation. Lesson 2. Contemplate if you are inclined to enterprising investing style. If you want to succeed with enterprising investing style, you first need to meet Mr. Market. Mr. Market is a theoretical concept reflecting the behavior of the stock market. Mr. Market every day offers you a price at which he is willing to buy or sell the ownership of publicly traded companies. The only caveat is that Mr. Market has a bipolar diagnosis. Like a pendulum, his mood swings between unsustainable optimism to unjustified pessimism. Without any significant change in the operations of most companies, Mr. Market could offer you to buy and sell them at prices twice the value or half the value depending on the mood. The most crucial aspect of dealing with Mr. Market is the fact that immediate stock prices do not reflect the true intrinsic value of the businesses being traded. Enterprising investing style is an attempt to purchase $1 of the true intrinsic value of the business at the price of 50 cents when Mr. Market is depressed. Thus your goal is to independently evaluate this intrinsic value, such as earnings, growth, and sustainability of the business. Remember, you are buying and owning businesses. Stock prices only reflect the current mood swings of Mr. Market and do not indicate your loss of capital unless you succumb to the panic and actually sell at the bottom. For this reason, some investors actively refuse to look at stock prices more often than once every several weeks or months. Remember the last holiday season discounts? You probably didn't get upset when your favorite brands were on sale at 50%. You might have rushed to buy more. So next time you face a stock market downturn, imagine the New York Stock Exchange building with a huge banner, sale. 50% off. Then the narrator exclaims, "Stocks become more attractive yet again," as the stock market dropped another 5%. Moreover, analysts are optimistic that the price can go even lower next year. The minor difference is that, unlike everyday stores, the stock market sale campaign might last for a few years. However, if you chose a good and growing business to invest in, the stock prices are bound to catch up with the growth of its earnings. Thus, you should expect to hold your investments for years to give enough time for the price to catch up with the increasing intrinsic value of the business. The old saying goes, if you are not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. Earlier we discussed that 90% of professional money managers underperform the defensive investing style. Why should you consider the enterprising style then? Because professional money managers have a lot of constraints that you don't. First, with big money to allocate, they can only buy companies with large market capitalization. And as we know, the bigger the company gets, the harder it is to grow fast. You can take full advantage of faster growing companies of any capitalization. Second, most professional money managers' funds are specialized. For example, growth stocks only or dividend-paying stocks only. Whereas lucrative deals always migrate across sectors. Third, professional money managers, as hired employees with salaries, have to compete on quarterly performance and growth of their assets under management. This way they are more likely to be motivated to show short-term results, not worse than other professional money managers. You can benefit from your ability to buy assets at massive discounts and wait for much longer for them to recover their price. As you can see, enterprising investing style is a matter of character. Patience, emotional discipline, eagerness to learn, and thinking for yourself. You might as well have these qualities. One last crucial aspect. Enterprising style requires a significant time commitment. It is easy to match the market average returns using the defensive investing style with a minimum time commitment. But for enterprising style, a modest commitment of time most likely will not result in a modest outperformance of returns. Usually, it ends up in lower returns. Enterprising investing style requires a lot of time to research individual businesses, often measured in hours each day. Ergo Lesson 2. Contemplate if you are inclined to enterprising investing style. By the way, please let me share a word of gratitude to everyone who has chosen to support this channel. If you haven't yet, please consider doing so. The link is in the description below. Now back to the video. Lesson 3. Learn how to select stocks for enterprising investing style. There are 3 major strategies for enterprising investing style. 1. Companies with temporarily depressed price-to-earnings ratios. It could be cyclical stocks in a downtrend or businesses experiencing temporary difficulties. 2. Businesses with a price significantly lower than the intrinsic value based on discounted future cash flows. Typically fast-growing companies with the potential to become multi-baggers. 3. Special situations like arbitrages, buyouts, or bankruptcies. Regardless of the strategy you choose, the most crucial aspect is to acquire ownership with a margin of safety. By applying a margin of safety, you invest only in companies that are traded at no more than half or 2/3 of their intrinsic value. This way you minimize the odds of permanently losing capital in the worst-case scenario. Because regardless of how thorough your analysis is, there are still a lot of things that can go wrong. You can make a forecasting mistake or be wrong about the confidence of your prediction in the unchanged environment. The environment itself might change, creating an unforeseeable situation. You also might not anticipate your regret reaction to the unfolding future, capitulate and sell prematurely. Remember, every time you are buying, somebody else is selling. And both sides think it is a good decision. An interesting exercise might be to contemplate the reasons why the other side is willing to sell a stock. What companies can be good investments? The book suggests a few key points to pay attention to. They include non-negative earnings per share in the past several years. Growth of earnings per share in the past several years. Your ability to confidently predict future earnings. Diversified customer base. Company investments into future growth. Competitive advantage business moats, such as brand name, monopoly, resistance to substitution, the economy of scale, etc. Company sustainable approach to mergers and acquisitions. Current assets are significantly greater than current liabilities. Long-term debt is significantly lower than net current assets. Absence of aggressive borrowing or share dilution. Preferably capital distribution to owners in the form of dividends or well-timed share buybacks. High return on invested capital. Competent and transparent management. Management motivation that is aligned with the goals of shareholders. Your confidence in the management to take good care of capital even during unprecedented circumstances or your inability to trade their shares for years. Favorable insider trading and institutional ownership. As each business is unique, these are recommendations and not hard lines. Use it as a roadmap to create your own understanding of the companies you research. Ergo Lesson 3. Learn how to select stocks for enterprising investing style. Thank you so much for watching. If you enjoyed this video, please like, subscribe, and share it with your friends.